hit the debt ceiling, something very dynamic happens. Yes, you can now make a payment because it would tax revenue hasn't come in, and so you don't have it. So you're not allowed to increase the debt, so you can't make a payment. But a lot, if not most, of the government's revenue is based on transactions like income taxes and that type of thing. And so if the government doesn't make a payment, that immediately reduces revenues, which would immediately say, okay, now you can't make that many payments, which immediately reduces more revenues. And it spirals down very quickly, and it spreads as things stop, government revenues stop, and the deficit, the debt can't go up. So the spending has to just fall lockstep with the drop in instantaneous revenues. And so you could see a total collapse of GDP of 10 and 20 or 30% in a week.
So if we go back to MMT, if this is not a solvency issue, now it's more of an inflation concern. What's going to happen to prices paid, CPI, PPI, however we measure that in terms of what the markets look at. When people look at the experiment of MMT in the policy response to COVID.
Well, stop right there. Stop right there. Which is exactly what they say, what you said, the experiment of MMT. MMT is a framework for analysis. It tells you that you can't debit an account without crediting an account. So what kind of experiment?
Okay, so when they did the policy, forget the experiment. When they just did policy.
But that was a good point you made, because that's how it's being promoted in the press as, oh, the failure of what MMT did or something. I didn't do anything. Just tell you that there are no spark plugs on a diesel engine, so stop trying to change them. Oh, well, Okay, so go ahead.
Yeah, okay. So in the wake of the policy response to COVID. Then the concern, or not the concern, everybody, the response seems to be, well, then you unleashed this uncontrollable upward surge in prices. And that's the danger of following, or that's the danger of acknowledging that MMT. So explain that to me and explain where we're getting it wrong.
So look, yes, but I'll give you the short answer by the government can spend as much as it wants and pay any price it wants to, and can cause as much inflation as it wants to. That's a policy option. And so they exercise their option to spend however many $1 trillion, realizing that it might cause prices to go up. And I think the Fed has attributed something like a 0.5 of the CPI annual increase to the increase in deficit spending. They attributed almost 4%, I think, 3 to 4, to the increase in energy prices around the Ukraine war, the spike in oil to 120, the spike in natural gas up to $9, and the pass-through of all that. And then they also had supply constraints, and because of COVID, that caused transportation costs to be higher, and startup costs and things like that. So that's all in there, and that's all been acknowledged. And they made the political decision that, whether they knew it or not, that it was worth it to keep everybody solvent, to keep everybody fed, to keep things going the best we can through COVID, in exchange for a policy that increased the price level by maybe 0.5% to 1% a year. The rest of it was going to happen anyway because of other external events. And you can debate whether that was the right policy or the wrong policy, but it's a one-time event. What the other understanding from modern monetary theory that comes from what I just told you is that the whole idea of inflation it's a series of one-time events. It's not you do something, you make one false move, and suddenly you're Venezuela or suddenly you're Zimbabwe. Okay, so you do this, prices go up a certain amount. It's not going to happen again unless you do it again. It doesn't like just trigger this runaway thing. And that comes from the understanding that the government, the Federal Reserve, okay, has, I'm going to say it this way, it's not quite right, has the dollars we need to pay our taxes. All right, they all come from the government. And so it is the monopoly supplier. Now, what it does to, when the government pays us, they just change the number in our bank account, the same way a scorekeeper at a card game would change the number in your account. So it doesn't come from anywhere. So when I say, they don't have or not have any dollars, but they have the spreadsheet. They're the scorekeeper. So we need our accounts credited. We need to get paid. at the macro level so that otherwise taxes can't get paid because that's the source. And so they're setting terms of exchange at the point of spending. So they say, okay, the tax liability is going to be $5 trillion this year. And we say, well, how do we get the money to pay the tax? Well, serve in the Army and we'll give you $50,000 a year. Become a Supreme Court judge and we'll give you $250,000. Sell me an airplane and I'll give you $2 billion, whatever. So what the government does, it's in a position of being the single supplier of the thing we need to pay taxes. And that is the source of the price level. And that is, without that, there's no explanation for where the price level comes from. And the mainstream models do not have a source of the price level. They don't even have money in their models. They just have relative value stories. And what they do is they say, well, we don't know the source of the price level, so we'll just start with this morning's prices, yesterday's closing price, and we'll tell you what makes them change or what's going on. So we have the CPI where it is, and with today's policy, we think it's going to go up 0.3 next month. So they don't know why it is where it is, except it's because it went up 0.3 from the previous month or 0.2 or whatever. And well, where'd that come from? Well, it came from the previous month. So all they have is an infinite regression because they don't understand the ultimate source of the information for absolute value rather than relative value is the fact that it's a monopoly. And everybody, if you took microeconomics 101, you learned monopoly in your first 15 minutes. It's the easy one. Then oligopoly took a few hours, and then you spend the rest of your life on competition, asymptotes, and calculus. But for monopoly, you don't need any of that. It's the easy one. Well, the money's the easy one. Okay, and they know the monopolist is price setter. If you have the monopoly for all the electricity in New York and nobody else can supply it, you set a price, 15 cents a kilowatt. You don't go to the market and say, okay, we'll sell you 2 billion kilowatts, all you homeowners. We're going to have a continuous bidding process for electricity. You set a price and let the quantity adjust. And that's what monopolists do. That's the path of least resistance. Well, the government doesn't understand that. And the analysts don't understand it, and the economists don't. It's never dawned on them that that's the case. But that's a very important contribution from modern monetary theory. So we know the source of the price level. We know that the price of electricity changes only when the electric company changes it. If their costs go up and they don't raise price, the price doesn't go up. They have to sit down and vote on it. We know that the Fed has to vote on interest rates because they're the monopoly supplier, the single supplier of bank reserves. And if they supply any extra, they have nowhere to go. The rate will go to zero unless they pay interest on reserve or unless they provide an alternative like Treasury securities. But they set that policy rate. So they go to a meeting and they take a vote. It's not the market determining the rate. Now you'll hear, you used to hear that got dismissed a few years ago with my debate with Robert Murphy. But the Austrian School of Economics used to say, that's the problem. We should let the market set the rate. Well, there is no such thing with floating exchange rate policy, which we have today. That is the case with fixed exchange rate policy, like a gold standard or Hong Kong or Bulgaria, where they fix your exchange rates, where the market can set interest rates. But here, it's a government monopoly. The Fed is a supplier of reserves. The system needs them. They set the price and they vote on it. So at each meeting, they vote up, down, or unchanged. It's the same with the price level. Go ahead. I see.
If that's the case, so first of all, do you feel that inflation at these levels is bad for the economy?
Okay.
Should they be doing something to address inflation? And then how do they do that given what you just said? Who should be doing that?
So you got three things in there, and I'll do in reverse order. So it's a political decision. And there's been no economic study that's shown that levels of inflation hurt the real wealth of the country or the economic growth. They affect distribution, who gets the money and who doesn't. And but they're just changing the numeraire. And you have countries like Argentina now running 100% inflation and low unemployment and good growth. Okay, so it's been going on for a long time. And so it doesn't do that. But people don't like inflation. So it does a lot of political damage. Okay, President Biden's taking a lot of heat for allowing the CPI to go up. So and he could lose the election based on that, like other presidents have. So it's political poison. And people, I've noticed or observed, would much rather have unemployment than inflation. In fact, when there's 10% unemployment, which is high, 90% of the people still have their jobs, and they want to hire somebody to mow the lawn or fix their plumbing. people are competing to get it and they get a good deal, they like that. It's a little diabolical, but that's the way human nature has worked, over the years. So when you get to low unemployment and suddenly I have to pay $80 an hour to get a plumber, it's like, could you live on that? Well, no, but I shouldn't have to pay that much, to change it. So from a personal point of view and from a political point of view, the politicians are better off with higher unemployment and lower inflation, I think.
Interesting. Okay.
That's my, it's not MMT or anything. That's just the way I look at the dynamic. Now, the other thing is we're using this word inflation, but it's a very casual word. It does.
It's kind of a catch-all, isn't it?
If the price of, cars goes up, we have car inflation. And, so it's like the price of food goes up, we have food inflation. It used to be a continuous change in the price level. Okay, well then we had CPI, Consumer Price Index, which is a very practically oriented political tool to make sure to see what people's standard of living is, and if it goes up, we know people are struggling and whatnot, and that became inflation. But that doesn't fit the academic definition at all. So when you say inflation this or inflation that, if you were asking me for real proposals, I'd have to ask, okay, what specifically are you looking at? Do we want to alter the consumer price index? And if you say yes, I say, well, we can just start reducing the tobacco tax and that'll go down. They'll say, yeah, but that's not what I want. Okay, but that's what my question was about originally. What is it we're trying to do? And you can't get a good answer from any of the people in authority to what that is. They just kind of go along with, well, everybody knows what it means and it's too high and we got to bring it down. So it makes it difficult for me to answer a question specifically about what I would do about inflation when you can't tell me exactly what it is and what the target is, right?
Right.
And I'm not trying to duck the question, but I'm just
it
saying
makes
that's the reality.
Makes sense.